Hello, hello. It's Money Mondays here. Ben and
I'm Feras, the more handsome, charming half of Disrupt Equity.
Oh, hush, 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 hush. You do.
So what are we talking about today, Ben?
How to get involved in real estate passively.
And you know what? If you go this route, you won't lose your hair like Ben did.
Oh man, I'll tell you, making deals is stressful. But so whoever came up with this topic is obviously very intelligent.
Absolutely amazing.
Very intelligent. But yeah, so we're gonna get started. Let's see. There we go.
And we're back.
What's going on, everybody?
Can you tell Ben has gotten a little bit less charming, a little bit less handsome?
A little less hair.
But you got the originals now, so we are the OGs. We are back.
No, but we wanted to thank Shanna and Avery from our team for being good sports. They totally caught us off guard this morning with the
Absolutely. So they walked in dressing up as us, and we try to give them all the hard things to do, and they politely passed on those. But figured they'd have a good time kicking off the show. So
No, it was great. Good time.
But
Good time.
Shanna missed one thing. Money Mondays. We do this every Monday, 30:30 Central.
Ish.
If you have comments, questions, thoughts, please ask them. I will be here on my laptop working. Answering questions.
Whoa, dude! I thought you were paying attention, dude. Come
Always
on.
paying attention.
Awesome. All right, so we're talking about how to get involved in real estate passively. All right, everybody. So we're going to kick this thing off, and I can barely breathe in this thing, but we're going to keep it rolling. What are the
Reach for the stars.
Oh. All right. So what are the main types of passive real estate investments? I would just say that, anything where you're not actively managing the deal or the business plan or the investment itself is going to be a passive thing, right? It's like stock investing, right? You're not managing the company that you've invested in. You're just buying a stock and then hoping that it goes up or maybe it has a dividend, right? Yep. It's the same thing. We are simply selling shares of an LLC that then owns the real estate. And as part of that, you're investing passively. So you're giving us your money. We're fiduciary. We have our fiduciary commitment to you to make sure that that property and that investment performs as well as possible, right? So from what we try to tell people is that you have 3 to 4 pieces of paper. Oh, I can't breathe in this dang thing. 3 to 4 pieces of paper that you have to fill out. You wire in your money, and that's it. Right? Now, we have people, we always ask them, that we want them to ask questions, we want them to review the paperwork, we want people to review the monthly updates that we put out there. But at the end of the day, some people just don't do that either, right? They want to have a purely passive investment. And so when we're talking about passive investments versus active investments, that's the difference. Me and Feras are active investors. We go find the deals. We put the deals together. We manage the deals. We are involved day to day, breathing this stuff every hour of every waking minute. Wow, kind of sounds horrible, right? Well, if you don't like that, you don't have enough time to do that, then you need to invest passively.
Exactly. Some of us, like, myself, I'm on all the time. Ben, doesn't do anything besides 9 to 5 every day.
Yeah, well, maybe 96 sometimes, right? But, so next question that came in before the show, right? Why would an investor choose a real estate syndication over a REIT?
That's a great question. We get asked this all the time, right? Dude. So for those who don't know, REITs are essentially publicly traded institutions. Institutions. That's the word I'm looking for. And ultimately, as an investor, you're buying stocks in this thing, but you're not really a direct shareholder, right? So with our deals, investors are getting a true K1. They're getting true losses that are passed through, and it's not, essentially, REITs are really designed as an easy way for investors to, whether they're accredited or sophisticated, come one, come all, be able to invest indirectly into real estate. Yeah. But the bulk of the money is being held by the REIT, right? In addition to those losses.
It's essentially a real estate syndication is you're investing like into a traditional real estate piece of real estate, right? A REIT is more like a stock.
Yeah,
right.
Syndication, you are a share, like you are an owner.
Of
you
the
just
real
happen
estate.
to have a lot of other owners alongside with you.
Yeah, and I think I would say the one benefit of a REIT over a syndication is obviously the REIT is liquid. It's on the stock exchange. You can buy and sell it at any time. There's typically a buy and sell transaction that can happen pretty frequently. And that's probably the benefit of it. So if you don't like to have your money tied up for too long, and you just kind of want to be in the stock market, a REIT might be more in line. But that's not true real estate investing in my book, right? You're investing in a stock that just happens to be something that's related to real estate, right? All right, next question. How do real estate syndications stack up to other investments in terms of the returns you can expect? Well, I mean, wow, talking about a loaded question. You can have returns up and down the spectrum,
Yeah,
right?
and I'd say there's not a right or wrong
Yes.
way to invest. There's not a right or wrong set of returns per se, right? Risk adjusted means something. So yes, a deal may make more
No,
than
but
the
what
other.
does it mean?
What?
We talk about risk adjusted though, right? Let's explain that to some people in the audience.
And risk adjusted just means, hey, what does the investment look like if things go wrong? Right, and are there a lot of ways for it to go wrong? And then basically, is it worth that risk to get that extra premium? Right, if I have two deals that are going to make me the same return, obviously you want to go for the one that is lower risk.
Yes,
naturally.
Yes.
Right, but now if the question is, how much do the returns need to increase until it's worth offset that risk?
Yes,
and everybody has their own appetite, right? So understand that because it really makes a big difference, right?
So let me give you another example too, right? You have a stabilized 1990s, 2000s vintage, 95% occupancy, it's humming, right? And that's gonna produce you a 15% IRR, right? But you've also got this Class C deal in a transitioning area that's got a bunch of down units. It's also gonna give you 15% IRR. Which one just sounds a little bit more risky? Right? It's definitely the Class C deal. So if you're trying to have a comparison, I would much rather go with the stabilized deal.
100%
right?
agree.
Because there's going to be so much less risk and you're getting the exact same amount of returns.
And unfortunately, this day and age, a lot of operators are really focused on just getting the higher IRR.
Yeah.
Right? All things aside, they're just looking at IRR and investors look at that and that's great.
Yeah.
But people are not understanding what that risk is like.
Yeah.
Right? To give you a good example, adding in preferred equity into a deal, what does it do? It reduces the cash flow, but it increases the IRR. So it's actually a better deal overall. But adding in preferred equity adds a little bit more risk, right? As an investor, you're putting someone else in front of you. So it's a good thing to have some pref equity, but again, you can play with that. And so as an investor, understand the risk in the whole deal structure and to start to finish, right? From the business plan being executed at the property, if you're upgrading 200 units, that's a lot of units to upgrade. It's not very easy to upgrade units, is it, Ben?
It's very easy. What are you talking about? I swing a hammer every Saturday and
if
Sunday.
you're going to reposition a property, bring occupancy down to 20%,
Yeah.
that's a lot of risk, right? So
Extremely
understand the risk from the deal business plan to the structure of the deal too, right?
Yeah.
Because there's ways to structure deals that are basically going to really put investors in a bind if things go south. So
Absolutely.
And I was
absolutely.
just talking to a broker earlier today, which I'll tell you more about that later. Earlier this morning about exactly that situation with another operator.
All right, so moving along, how would an investor get started in passive investing? And I think it really goes back to if you're just interested in real estate in general, get yourself educated, folks. That also means you too, passive investors. That also means that you might have to do a little bit of networking as well. And you're gonna say, well, I don't have any time to do any of that. Well, you're never gonna find anybody that has deals then. Yes, you could probably Google some people and maybe you'll find some stuff, but you ultimately need to have a conversation with those people. You need to network with those people. You need to get to a point where you like, know, and trust those people because you're giving them your hard-earned money. Right? So if you want to just say, hey, I'm a doctor, I work 90 hours a week, I have no time to be an active investor, I don't have any desire to do what you and Feras do, I just want to put my money to work. Well, guess what? You need to get yourself educated on just real estate investing. You need to get yourself educated on multifamily if that's something that you're interested in. And then ultimately determine what that buy box is, right? Now, we have a buy box on the active side, but as passive investors, we have people that are very, very specific about what they want. I want Class B deal built in 1990s in primary markets. Okay. So you're not looking at anything outside of that. That's the only thing you're going to invest in because you feel like that's the best investment for you at that time for your family. So you're going to need to get educated in order to make that call, right? So get yourself educated, do some networking and find people that have deals, Get yourself educated on the paperwork that you're going to be signing off on, right? You know, if you have to get your own lawyer to have them distill down what's in the PPM and explain it to you, it's probably worth the $500 or $1,000 just so you understand it. Now, people are also going to ask, well, can we negotiate or tweak the PPM? You're not going to be able to do that. Nobody ever does that, right? So if your lawyer comes back and says, there's these laundry list of red lines that I want you to go back to them with, the people are going to tell you no. But it's still nice to have a lawyer that is working for you to explain the concepts, explain the risks, which is what a PPM is all about. And so now you understand the paperwork side, and then it's ultimately just all about taking action.
Yes, it is.
Make the wire, you know, invest in something, right? And sit back and watch your money grow over time, right? So moving along, what are some risks as a passive investor?
I mean, you know, ultimately, any investment has risks with it, right?
Yeah.
You could lose all your money, right? It's happened before.
Yeah.
It happened. It's about understanding the operator, understand the deal, you know, and invest with someone you like, know, and trust. And trust includes, are they structuring the deal, you know, essentially to reduce that risk, right? From the reserves, from the deal structure itself, from the price point they're buying it at, right? All these things factor in the risk. And so, you know, hopefully as an investor, you never lose your money, right? Nobody ever wants to see that happen, right? But it does happen. And so get into deals with people, trusted track records that know how to structure deals, reduce risk, and basically set everybody up for success.
And I'd also say, you know, I mean, you know, what's some of the other risks? And he said that obviously you can lose all your money. It's limited. You're an LP, so it's limited to the investment that you have in there. So if you put $100,000 in, regardless of what happens, there's fraud involved, the thing gets nuked, whatever might happen, the only amount of money that you can lose as an LP is your initial investment, which is the $100K, which would stink, right? And I mean, that's a lot of money. Right? But I always like to tell people and really let them know that. Now, as a GPs, if we're signing on loans, if something went wrong, we could be personally on the hook for certain things, right? You know, but that is the risk that we're taking on as the GPs, the general partners versus the LPs, right? It's also a manager-member, you know, relationship too. So look up all these terms online. There's a lot of information about this. Again, you're investing in an LLC. I'm selling you shares of that LLC. And that LLC is therefore buying the property, the real estate, right? So what are some of the benefits of being a passive investor? Again, it's right there in the name. You're passive. You don't have to do anything, right? So I'd say that's probably the biggest benefit, right? You can go enjoy your weekends, you can enjoy your families, you know, and you have the brunt of the work is being done by the GPs or the active investors, right? Last but not least, what are some factors you should consider before saying yes to a passive investor deal? I would say, just like Feras said, you're looking for proven operators that got good track records, that you like, know, and trust, in markets that you want to invest in, that you feel good about the long-term, you know, I guess, growth of, right? You know, I mean, that's why we invest in the Sun Belt. We believe in the long-term growth of the Sun Belt states, right? Not to say that you can't make money in California and New York, and we have people that are up there. Obviously, real estate's a thing up there, but that's not what we invest for, right? And so you need to determine what am I looking for? Am I looking for cash flow? Am I looking for appreciation? Am I looking for tax benefits, right? What are those things? And then you need to go seek out those deals and those operators to find those, right? And then, boom, you pull the trigger, take action, you do your wire, and you're in. So, we got through that pretty quick.
Absolutely. So, Monday Mondays, we do this every Monday, 3:30 Central. If you have comments, questions, thoughts, please leave them. We will be happy to answer them, whether you want to understand where I got this cool hat from, right, or what mask Ben is wearing, right? We're happy to sit here and talk about all of these things.
Boom. Bye, folks.
If not, we can keep going, so
Ooh, and I can't
going
skip
once.
that big thing. Nobody has any questions?
I guess everybody knows,
Everybody knows
what
how to do
investing,
passive investing.
Yeah. That's the easy part. People want to understand the buy, not the investment, Ben.
No, that's fine. That's fine. Hey, you know, but if you have them and you don't want to maybe ask them in a public forum, obviously reach out to us. We love to obviously talk shop, or you might get it on the next show. So, MFIN.
What are we doing in 2 weeks? 2 weeks? 2 weeks.
MFIN, the Multifamily Investor Network Conference in Atlanta, Georgia. So you're getting your buy one, get one.
Today is last call, and this
off.
thing is, I think, about to sell out. Actually, we've been
And I think we have more tickets sold than we did in Seattle.
Yeah.
We booked that one up too. So get in, folks. We're not joking. This thing is going to sell out. We got some great speakers, great panelists. It's just going to be a great opportunity for you to network. Even if you're a passive investor, you need to develop relationships with people that have got deals. Hint, hint. So check it out, www.mfinvestornetwork.com. Put in coupon code DISRUPT, and get you buy one, get one, $150 off on executive tickets.
And one secret, we are going to do a property tour at our apartment to office to apartment conversion.
No, this is actually a cool project.
That'll be for VIP first, but there will be some slots open for the public. So, come check out the conference, and you may be a chance to go see that. It's just a pretty cool project right in the heart of downtown Atlanta, converting an office building into an apartment, and go see what that looks like.
No, it's a huge project, folks. We're spending more on the construction than we did on the actual building itself, but it's right downtown. It's right downtown. It's right by CNN, by the stadium, by Georgia State. We're really, really excited about this project. It just happens to coincide with, obviously, us being in Atlanta for our conference. So we're going to be doing that, I think, Sunday.
Yeah.
But before that, we always have Friday networking. The day of the conference is Saturday. People hang around for Sunday and go see the property tour.
It's a fun time. Go meet other operators. Go meet experts in the space. Go learn, educate yourself. The thing we like to tell everybody, the best way to get started is to go get educated first.
Absolutely. So that offer expires tonight at midnight, actually.
Yeah.
All right, so get in on that if you are still looking for something to do November 12th. But before that, man, it's already that time of the month again, man.
Absolutely.
The meetup time. Analyzing multifamily real estate deals. We are talking numbers, folks, at Wakefield Crowbar, November 3rd, which is this Thursday here in Houston. We're having our monthly meetup, which we do the first Thursday of every month. DisruptEquity.com/HTX meetup. Go ahead and register there. We always have a packed house, 150 investors come out there. We always have great topics, great speakers, and maybe, hey, come with some questions, come with some deals, come with some money. Whatever you got to do. We're there to network. We're not there to sell you anything. But check it out. Register there at DisruptEquity.com/HTX meetup. And then, last but not least, our virtual meetup that we do the second Wednesday, right, of the month, I think.
Yes, we do.
I think so. So November 9th, which is next week, next Wednesday, maximizing your wealth with Infinite Banking. So we're going to have our friends over there at Infinite Banking, or Infinite Strategies, David White and Erica Neal. Great folks. I use them. They're awesome. So check that out, DisruptEquity.com/virtual meetup to register for that event as well. Again, that's an online virtual event, Wednesday, November 9th at 7:30 U.S. Central. DisruptEquity.com/virtual meetup. But what are we talking about next week, man?
Talking about the difference between IRR, cash on cash, and equity multiple. A lot of terms that get thrown around randomly.
Scary.
Sometimes people focus on one or the other and don't really understand really what it all means and how do these things tie together. So this is a topic I'm usually pretty interested in because I think there's good ways to explain these more complicated concepts in ways that people can understand, which hopefully will help you.
Passive and active investors need to know all of these concepts.
And I'm willing to bet most active investors cannot explain what IRR actually is.
No, definitely. You got to have a spreadsheet to do that.
You got to have me. So.
But hey, thanks for tuning in, folks. Happy Halloween, all right?
All right, thank you very much. Look forward to seeing you guys next time, Monday, 3:30 Central.